Home mortgage rates continue to climb. People are starting to talk about record high mortgage rates. Well, they're really not record high. We're going to look at that, but I'm going to explain to you the effect that mortgage rates tend to have on the prices of homes, and I'm going to demonstrate to you exactly why that is. So first and foremost, what have mortgage rates been doing? As you can see here, we are here. This is a graph. We are here at the very far right. This is 2022. And as you can see, mortgage rates have now surpassed 5%, and they are getting very, very close to 6%. Now, mortgage rates have not been that high since roughly 2009-ish, which was the time of the Great Recession. But importantly, if you look over time, mortgage rates have essentially declined since the early 1980s. There's a lot of historical reasons for this and political decisions that have been made. We've talked about some of them on the political side, the David Pakman Show. For us here, what's important is just to contextualize where mortgage rates are now. Mortgage rates are higher than they've been for a while, but they're basically where they were about 14 years ago. Let's now talk about why it is that high mortgage rates tend to push down the price of homes. Let's imagine that you are a home buyer and you have determined that you have a $30,000 down payment that you've been saving up. And please excuse my handwriting. I am doing the best I can here. I've always had terrible handwriting. And you've determined that what you can afford is $1,500 per month. Great. This is sort of like our financial picture. If we plug these numbers in to basically any mortgage calculator, and you put in that there's a $30,000 down payment, you will very quickly see that when mortgage rates are, for example, 3%, what you can afford, and let me make sure I give everybody accurate data. We're talking about just the mortgage here. I know that we would be talking about PMI and a lot of different things, and we're just not going to do that because it's just sort of like beyond the scope. You can get that payment with that down payment for about a $385,000 house, okay, when rates are 3%. So if we just take a look at this, we'll have a little chart here. So we say rate and then home. So with these inputs, a $30,000 down payment and a budget of $1,500 a month, when rates are 3%, that allows you to buy a home that's $385,000, okay? So simple mortgage calculator, 385, 30,000 down, 3% rate, it gets you that payment. It's actually the exact payment would be $1,497. Simple. Now, I know many of you will say, David, if you only put 7% down, you'll have to pay PMI. This is just an example to talk about the pressure on prices. It's not meant to be exactly illustrative. Okay. All of a sudden, if rates are 6%, this is a dramatic change that you're going to see. If you still have your $30,000 down payment and you can still only afford $1,500 a month, you can now, and I don't know why we're still figuring out the technology here, folks. You will see that with a 6% rate, you, in order to keep your payment at $1,500 a month, is actually $1,499. With a $30,000 down payment, you can now only afford a $280,000 home. So nothing has changed about how much money you have. Nothing has changed about what you can afford. But what has changed is the prevailing rate. It has gone from 3 to 6%. This takes away $105,000 from your buying power. Now, if this starts happening to everyone, you start to see how it puts downward pressure on homes. The opposite also works very much. Okay, so we could take another example here. Imagine, and now let's talk about slightly more expensive homes. Imagine that you are looking at a $500,000 home, and you've got 20% down, which is $100K. All right. When you're looking at such a home and you're putting $100,000 down, and rates are, call it 5%. 5%. I think what happens is when I switch windows, it doesn't like it. You've got 5%. that gives you a payment of $21.47. Merely from seeing rates go down to 2.5% in this exact same scenario. Now, this is a big difference. All of a sudden, that same house, 500K, 20% down, it's only $1,580 a month. This gives you way more breathing room where now you say, hey, you know what? $1,580 fine. I could afford the $21.47. So if a lot of people say that, someone will say, well, I'm willing to pay $510 for the house. Someone says, well, actually, I'm willing to pay $550 and my payment will still be under that $21.47 that I was budgeting when rates were 5%. This is how prices of homes get pushed up as mortgage rates come down. So, of course, the concern as mortgage rates go up is that it will slow down the housing market. We're already seeing it. I think in the biggest 50 markets, things are taking longer to sell, significantly so. And there are more price adjustments that are taking place. This is the primary mechanism to understand. And of course, when we think through, if indeed you expect, so there's actually two functions that happen here. If this starts to happen, it can slow down the market. People waiting for mortgage rates to come down can also become a self-fulfilling prophecy where it's just about getting a better deal. So there's a bunch, there's sort of like, there's a feedback loop that can take place there. The other issue is for cash buyers, this is good. This is actually good for cash buyers because if you have cash and you don't care about this interest rate, right? If you have cash, if the interest rates going up push prices down, you've just saved $105,000 in cash in this first example. So this is why when this particular movement happens, it can be very good for cash buyers. This includes big financial corporations, which want to sweep up a ton of real estate to then rent out. And it can cause some less than ideal activity in the housing market. Also another important component.